Hi, everybody. We're joined by Peter Goodburn at Elliot Wave Track. And Peter, welcome back to TradeGate Hub. I just want to acknowledge a great call you made about a break in the S&Ps in January. And I see you have your long-term stuff up here. But, you know, if we could go a little shorter term and show the recent low in the bounce, I just want to tell you a story I heard. So welcome back, buddy. It was that Monday, and I believe there was a big hedge fund meeting or conference in New York, and I turned on CNBC, and we had that reversal down there, which you called the end of wave 3, and we did get a bounce from there. But what I heard from the hedge fund manager lady was, we are so relieved. Okay, thinking that was it, that was a low. So here we are. I mean, bear market rallies are vicious. It looks like that's what you're saying up here, is that this is a failing rally.
Yes, hi Dale. Thanks. It's great to connect with you again. And I think, yeah, I mean, it's an interesting story you mentioned there, because it gives us a bit of a snapshot, doesn't it, of sentiment and where the pain trade is. When we got to that low last week on the Monday, I think it was, from an Elliott perspective at least, as obvious as it could be that was putting in an excitement low. You know, it was an exhaustion low. You can always tell because it carried over from the Friday before. And on a Monday morning, you tend to get these extremes.
Swoosh.
Yeah, and as we see it a bit sort of picking up momentum in the European markets, you know, earlier than when New York opens. And then when New York opens, we know that there's going to be the exhaustion sort of scenario set up, especially if we've got some idea that we're approaching a low. I mean, it was a pretty big drop, because I mean, here we've got a log scale chart of the S&P 500. And if I just select 1618, I think everybody's familiar with that ratio.
Yes.
And extend the initial 5-wave sequence down like this. If I just double click, you're going to see it projects the 1618 target right into that there. Monday morning low. Yeah. And so we had a sort of a pretty good idea this was an important number. And then of course it carries higher. Now we, for one, thought the initial upswing here was a tiny 3-wave pattern, and we thought, well, that's not going to end the correction, because it's too quick, too sharp, in contrast to the amplitude of the previous decline. So normally you either get sort of time consumption in a sideways pattern, or you get something like this where, you know, you get more extreme move. I thought that actually at the time,
a lot of guys were looking at 520 as being a possible stopping point.
520?
Yeah, 40. I think 45.20. Some people were thinking was going to be, but we got up to yesterday's high. Do you think it's it in light of Facebook? And you know, Peter, I was thinking about your bearish thesis even longer term. And you know, $5 stocks can move 10-20% in a day, either way, up or down. But when you start having mega caps like PayPal and Facebook yesterday and Netflix last week, those kind of moves, to me, say that there's something wrong with market structure, that you know, that much market cap could be taken away in less than 24 hours.
Yes, I mean, when you do see those bigger stocks,
it doesn't build confidence, for sure.
No, it doesn't. I mean, Tesla, I was looking at the other day, and actually the decline from last year's highs has unfolded into a correction. And we're sort of constructing a sort of a fairly optimistic bullish count for that, because, you know, that one could buck the trend. But when you look at some of the other broader ones, I mean, we've been seeing the technology stocks, even some of the bigger ones, start to lean over to the downside. We had pretty good idea as we were crossing over into New Year that some of these bigger stocks, some of these bigger technologies, which are forming part of the FANGs index, would start to roll to the downside. I mean, the FANGs index is actually pretty good to track. You know, you get a good smidgen of stocks in there.
And all through last year into the last part of the year, when the majority of things were making new highs, Amazon hadn't made a new high for about 6 months. So that was kind of a market tell. Also, the false breakout to the upside in Russell, that everyone was celebrating that breakout. And then when it negated it, it was history. So, so we're going to make that lady who was relieved feel uncomfortable, but just for a little while, for about 100 pips or so. And that would be the end of the first wave of the correction that you're looking for, correct?
Well, that's right. I mean, I think that there's a couple of things which are really pertinent to the way in which we've rallied so far from Monday of the previous week up to these current levels. First of all, when we originally plotted this, we thought that, we would get up, something probably 44.50, something like that, and then drop down to continue the decline from January's high as what we call a 5-wave expanding impulse. You tend to get in those situations a 3rd wave, which is longest in the sequence, and that expands the price level. So this is a typical 5-wave pattern that everybody's familiar with in Elliot Wave terms. This one is not a 5-wave expanding impulse. We're actually drawing it as a diagonal impulse because we've got overlap. This big swing up has extended this week, and we've actually gone and kissed the first wave, slightly penetrated, so it's gone into the price territory of wave 1. So by definition, it negates the 5-wave expanding impulse pattern. But I'm pretty certain that this is a corrective process up here from Monday last week, and therefore, we must assume that this has just transferred itself into a diagonal instead. Now, there are some implications with that for everybody. First of all,
could I interrupt you? And I was thinking, because I talked to other strategists, Ellioticians, and is it possible, because of this little overlap, that we get one more flush like you're looking for, and that could be the end of a bigger wave 4, and that we move to new highs? Is that a possibility?
Yeah, it is. I think it is. And that's something that's concerning me a lot at the moment, because if we're transferring from an expanding impulse into a diagonal impulse pattern down like this, then we've got to be very careful that this is not necessarily a first wave in a broader decline that we're seeing, which was my original assumption.
Right.
But maybe the
still
end
worked.
Is,
yeah,
to some extent.
It was still a great trade, even if it doesn't turn out to be the top. But because of the action of this correction, you're opening your mind to the fact that we could be at the next low, setting up a very important low for maybe a blow off or a melt up if the market gets comfortable to with what the Fed is doing, or they walk it back a little bit because they can.
Yeah, I mean, we're just me and my team here. We've been discussing this yesterday and today, and so we're in the middle of constructing some alternate scenarios. It's very important to go through that process, if you've deviated from the plan exactly, because your mind can ultimately sort of adopt something, and it goes into sort of the wishful thinking mode, and you'd be surprised how rigid the mind is when it grasps something, and you put a lot of energy towards it. A human being's natural bias is to hold on to something, doesn't want to let go. And one of the things that, if you're a practicing Elliotician, is to learn to resist that human process, to be as flexible as you can, to always ask the question, to be investigative all the way. And we just want to sort of paint up and draw up some different alternate scenarios, what ifs, if you like, because that way we release the energy stream that would normally hold on to something that's not going to work. I still think that absolutely, my conviction is very strong here that we're going to drop into a lower low. So I think all of this upswing that we've seen over the last 7-8 trading days is going to reverse, and we're going to head down. But then the big question comes: if we get down to this target, something like 41.50, what happens next? And that's the sort of alternate things that we should be looking at. Now, there's something very important here with the diagonal, because if this is a leading diagonal, no problem. This is wave 1. We go up in 3 waves, collapse later. we keep the downtrend going. If this is an ending diagonal, okay, it can only be part of an expanding flat because this is 5 waves down, and the only sort of correction that has a 5-wave component like this is an expanding flat, in which case then we'd have to go back to this top here in November, count down A, 3 waves up, B and C down. But there's an interesting concept here. How do you know whether a diagonal is a leading or an ending type? Is it a first wave or a fifth wave or a C wave in this case for a correction? Well, it comes down to the components of the impulse waves. You see, in a leading diagonal, this is depicting a leading diagonal with as a first wave. The impulse waves 1, 3, and what will come as 5, they should be subdividing into 5-wave sequences. Can we see 5 waves down in wave 1? Can we see 5 waves down in wave 3? Well, in this particular example, the answer to those 2 questions is yes, we can, both in waves 1 and 3. So in a way, it's giving us a bit of a clue that this should be a leading diagonal, not an ending type. So that when we get down here, we're not positioning ourselves for higher highs, we're just positioning ourselves for a 3-wave rally.
Okay.
So that's one clue. The other thing is never rely on just one index. Test this thesis on maybe the Dow or the NASDAQ to see what they show. And that's something that we're doing already. At the moment, they seem to
NASDAQ displaying more weakness, right?
Yeah, they seem to confer that this is a leading type diagonal. Okay, which would play into the idea that after it finishes, we're going to get a 3-wave concept rally back to maybe this resistance of wave 4 preceding, which is where we are now. And then it would start to decline again. But I have to say that I am a bit concerned because when I take a look at something like in European markets, like the EURUSD 50, we've got another diagonal pattern there. And the components are somewhat different. Those components down look to me more like 3-wave subdivisions here, in this sequence here and here. That would imply this is an ending type diagonal. So that's something which we're trying to get out.
Yeah, that's interesting, Peter. Because could that play into one more wave up in the dollar and the Euro stocks break with the S&Ps, risk off maybe an invasion, and people go the dollar one more time? And I have noticed that in recent days, things like Brazil's ETF and foreign markets in the last several weeks, because the dollar's become more two-sided and really had a nice decline today. Could this be a harbinger of what happens in 2022 once we finally get this top completed in the dollar?
Well, I think that's a good point, because these asset correlations are pretty consistent. Some of the short-term movements might disengage for a little while, but generally they're pretty good. And it's been my conviction for quite some time that the 10-year Treasury yields will get up just slightly above 2% before they end the post-pandemic rise, which we can have a look at that in a moment as a zigzag uptrend, if you like. And once we get above 2%, I think that will coincide with this dollar getting up to about 98 figure. This rather large dollar decline that we've seen this week since last Friday's high.
That surprised me.
Yeah, that surprised me a bit. I mean, we were expecting a bit of a correction, but not quite as much. But then that is atypical of what we've just seen in some of these big volatile movements. Now, this is unfolding into a diagonal, which is going to take another 4 weeks or so to finish to get up to 98. It's a diagonal pattern. Yeah. And this accounts for why the dollar suddenly pulled back. In fact, you can see the dollar dropping down this morning. And, we've only got a smidge more to get to the 76% area. In and around that area, I'd expect the dollar maybe later today to suddenly put the brakes on and then start to turn back up. So keep a lookout for that number. It's around 95.29, give or take 10 pips or so, I guess, maybe max 20. But I mean, ultimately, that dollar up at 98 figure should coincide with 2%, I think, on the 10-year yields. Okay. And once that happens, there's definitely going to be a very big correction in 10-year Treasury yields, and we're going to get down, below 1%. So what do you think the stock market's going to do during that phase? What's going to cause? Yeah, what's going to cause the yields to drop? Well, let's have a quick look at the 10-year yield chart now. We've seen the dollar, because my thoughts are this: these asset correlations are pretty good. Here's the 10-year,
right?
10-year yield at 2%.
Yeah.
If I show the bigger picture, that's probably better. And you can actually see now from the pandemic low, you've got a big zigzag. And here's when the Chinese started dumping treasuries, and that immediately after that lifted up here. Then we got the B wave, and if you just extend that by 38%, here's our target that derives 2%. And if we take a look at the internal structure of wave C of this 5-wave pattern, it confers that 2% number. So we've got to get a little bit higher, okay, before we start turning around. Now this pattern I'm very secure with, because in a moment maybe I'll show you the 30-year bond yield, which is a different pattern, but it confers about another 20 basis points up, and that's it. Then we're going to come down like this, and this is a big swing down below 1%.
It sure is. Yeah,
it's a big swing down. So what do you think stock markets are going to do if we get that sort of retraction to the downside? Yeah. I personally think that it'll be
part of risk off.
It's going to be risk off. I can't, I've talked to several institutional clients about this. One or two have said, hey, could it be that, that stock markets will trend up because they like to see lower yields? But generally, it doesn't work like that.
Right.
I tend to think that this is a risk off phase. This is too big. This is not just a small short-term correction. This is much bigger than anything that we've seen since the rise from the pandemic low. So I think this is a really important juncture, which will translate into, as you say, risk off on equities. So if we go back to that equity concept where, when we get to a lower low, perhaps in the next few weeks, is that a transient point where we just get a 3-wave correction up before turning down again later, or do we actually get a slightly modest higher high? That is still an open question, but given in the backdrop of this, you would rather think more in terms of it's going to be a 3-wave correction before it heads down afterwards, wouldn't you?
Yeah,
that would be the logical way to think.
Yeah, and dollar peak and metals go, metals bottom. So interesting on this. I'm interested.
You mean precious metals bottoming, right?
Yes,
not base metals. Yeah.
No,
okay.
Precious. Yeah, I know. So you probably like the copper gold ratio, and I saw an interesting chart. The Dow gold ratio finally broke out of I don't know, like 20-year channel.
I don't like this gold ratio. No, I don't like it.
Yeah.
I mean, no, it's I don't like it because the
they changed the Dow.
The thing is, you've got it's a bit like comparing an elephant to a rabbit.
Yeah.
And trying to make a ratio out of that. I mean, it doesn't make sense.
There's no correlation.
The scale is too big on one scale. The Dow has got a huge, vast. I mean, if you put if you divide it maybe into a ratio, you might get some information out of it. But I get more information out of looking at them individually rather than looking at a ratio like that, because the Dow has gone exponentially higher for a decade or more, and you can't say the same inverse pace or has happened with gold, because gold's seen big declines since 2011 and then gone back up again. So I don't know whether it's so meaningful to look at these types, that particular type of ratio. I know people do look at it, but I'm not sure whether you get a great deal of insight from it.
Okay, here's a question. Dollar peaks, precious metals bottom, not industrials, because I know you're looking for a pullback in commodities. And you know what? After this, we'll attack oil. But so this all happens, dollar peaks, starts heading down. What's going to outperform, euro or gold? I know you prefer silver's going to way outperform. So what's going to outperform, being long euro or Aussie or long silver and silver miners?
Well, I really like silver as an outperformer. I think that's, you see, on the gold front, I think we're in the short term, we're going to drop to about 1720. So we got what, another,
yeah, $80,
70, yeah, $75 to go.
Yeah.
And then we start buying that. And then I think that gold is going to take a look up here, but it probably won't go much higher than 2072 before it drops back down inside the range. I think we're going to go through a similar sideways pattern here as we saw here. I know people in Elliot Wave communities start talking about alternation. If one is complex, which would qualify for wave 2, wave 4 should be simple. And that's not a fixed rule. That's a guideline only. And I can say there's plenty of occasions where you get a simple correction in wave 2 and a simple in wave 4. Other times it can alternate, and other times it can be complex. The reason I'm thinking that this is going to have a look back up to the highs and not do any more than that and then drop back down again is, one, because of our analysis on cycles, which show a very similar upswing here into much later this year and then a drop down. But also this initial upswing here is a zigzag, and that's not a 5-wave pattern. So that's giving us a very stringent clue that that's not going to start we're not going to start a new uptrend this year. It's going to go up quite a bit. If we extend that by 61.8, look, we're just coming back to the highs, slightly around there.
Right.
So there's some good qualitative sort of measurements in there. Why I think gold will trade back up here. It's a good trade to have, but then pull back. But if you take a look at silver, we've got an outperformance situation going on. And I think silver,
although short term, the gold silver ratio looks like it's pushing up above 80 again, taking out the prior corrective high.
Let's have a look at gold silver ratio. Yeah, I mean,
did you see that?
Yeah, I mean, here it is here.
Yeah.
Yeah, that could actually widen out a bit more. It's possible.
Yeah, like 80. Just take out the prior high a little bit.
Yeah.
Yeah.
I think the bigger perspective, though, really interests me, because here is this is let's go to something really long term. This is going back to the 1930s.
Oh,
this is the gold silver ratio going back to the 1930s. Yeah. And this is a huge leading diagonal, 5 waves.
Yeah.
And this is a good example of a leading diagonal, something we started with today's presentation with the S&P, but on the downside, 5 wave components here always. But this is the pandemic point.
Right.
Now this is a closing quarterly chart, so the highest was 112 closing, but of course we got higher on the intraday. But the fact is that this will now have to retrace back to wave 4 proceeding over the next several years. So this means silver ultimately will outperform gold.
Yeah, for years.
For quite some time.
And 40 was kind of a mean for a while. I remember it being in the 40s for a while. I'd like to, if we can, with what's happening, as far as energy supplies and stuff. And I just see the weekly crude chart, Peter, as you would probably call it an ending diagonal. To me, it's a 3 drive to a top formation. And we've been diverging for over a year. And this recent high in the crude, the RSI is well under 70, which is kind of a higher probability turn because it's showing the waning momentum. So looks like we're in the final stages of something up here with your work.
Yeah. Actually, I'm trying to short oil today.
Yeah, I've gotten stopped out a few times trying it.
Have you?
Yeah.
Yeah. I mean, there's definitely a high coming here, and the bigger picture has been somewhat corrupted because of this big drop when we saw that expiry. This is the June expiry of 2020. The May contract, as you remember, went down to -40 or whatever. But The front month deliverable at the time was a low at 650, but even that was distorted basis the Brent contract,
You
which
know,
was
you
about
want to
50.
make our President's Day.
Huh?
Send this chart to President Biden. He will be so happy in the summer if you're right. You know, if this manifests, because you know, going into the midstreams, he could say we're winning the fight against inflation if by the summer crude's trading under $40.
Well, he's got to win something, isn't he? He's a I mean, if you have about 20 goes at something, you're going to win something once.
Yeah, that sounds like my trading, but this would really make his day, Peter, if that happened. And this is how we could get that big yield drop after 2% too, isn't it?
Well, I think this is definitely the way things are going to transpire, because I think we're going to get I think the yields will come back to that 87 basis point target, which is about a 50% correction of the post-pandemic advance up to 2%. And I think oil will have to regress down to a 38% retracement level. I mean, this is obviously, if you in price terms, coming down to a 38, just a generic 38% retracement, just in case you don't believe your eyes here. You know, this is the 38% zone. But this is obviously measured on a logarithmic scale. Interesting, isn't it, that the 38% retracement level hits wave 2 here?
Yeah.
So in other words, you could just extend wave 1 through to 2 by 61.8, and you get the same derivative result. So this is a mathematical certainty basis the algorithm of using a golden ratio. But that would represent about a 60% price drop.
So I could see a few things happening. The Olympics are happening in China, COVID spreads, and they still have their zero tolerance policy. And after the Olympics, they lock down even harder because there's been more spread. Biden can cut a deal with Iran, would bring 1 million barrels of oil back on the market. What does he have to lose? Has tried to get back into that treaty. That could create, on the marginal side, an oversupply. So the couple of fundamental events I'm looking at, maybe Putin withdraws. I think that's part of it. I don't think that's going to happen. You know why? Because it's the year of the bear, Peter. And we're poking the bear in the eye in Russia.
Year of the bear, year of the tiger. Are you talking about Chinese New Year or what?
No, I'm talking about markets and Russia.
Okay.
The Russian bear, the
well, I tell you
bear,
something.
the dollar bear, huh?
Well, I don't know the reason why these prices will come down. I mean,
know.
The obvious reason is that the Fed has started tightening.
Yeah.
They've got themselves into a bit of a panic mode, and the idea that that if the Fed are panicking, they're giving the lead for other central banks, including the European Union and maybe the Bank of Japan, and they all start tightening, and then eventually the market sort of tilts over because we've already extended and expounded a lot of energy in this 2-year rally. So it could be something very, very simple like that. I'm actually fielding quite a few meetings with institutional clients this week, talking about Russia and Ukraine, whether the Russians will invade. That is the obvious question. The Russia RTS index has dropped quite a bit.
Yeah.
I actually came across a Russia ETF during the analysis this week. I haven't drawn it up properly. I can show you my draft. But
I know that you liked the ruble too, with the dollar peaking out. So, I mean, does that tell you anything about an invasion if the ruble begins to appreciate against the dollar?
I think so, yeah. I mean, I'll show you the ruble because I think the ruble.
What's the spread on the rubles at TradeView FX? Anyone know? Mike, can you check that out for me? Thanks. Go ahead.
Okay. Here's the ruble. Actually, we had a really great forecast on this. I mean, anybody tuning in will be, well, hopefully.
Yeah, I remember you looking for this one more push up here.
Yeah, I mean, I think going back to Let me just try and find
That's a
something
hell of
here.
a move. That means it's
Yeah.
going to appreciate by what?
Well, that means it's going to appreciate.
400%.
Yeah, I mean that's going to appreciate quite a bit. I mean here, I'm just showing you what we predicted.
Yeah.
This is going back to October when we saw this breakdown. We could see that this was a zigzag pattern, and that somewhere down here around the 69 level, we would bottom out and then start this rally up to 80.20. And if I'm
now we're there.
Yeah, we've bottomed out there. Let me just.
I also noticed that the yuan tried to turn the corner, USD yuan, before we had the euro pop. I mean, the week before, there was some, China started to devalue a little bit. Does that have anything to do, or can you read anything into? Okay, so you just have it as a pop, and we haven't bottomed. Okay.
Yeah, I mean, I think again, look here. You've got this 3 price swing event down.
Yeah, that's what I saw a rally coming.
When you get something like
nice
that,
trade. Yeah.
Yeah, it's nice trade. I mean, you can take it up 10 pip, you know, sort of 630 to 660, 35 pips. But I think after that, you know, we're heading down again. So this implies that there's a bit of a dollar swing up. But coming back to your question about Russia, I don't think there's going to be an invasion because, you know, if we take a look at that ruble, as we did just now, you know, that's hit the 80 mark and is trending down. That implies ruble is going to strengthen. And I came across this ETF, which I'll show on my worksheets for those. I mean, this is not finished yet, so we normally don't show this to everybody, but just for you only.
Oh, really? This is
now. This is a now. Look at this.
That's what people say. They go, I'd like to interview you. They go, oh, that would be an honor. What, just to talk to me? Come on.
Well, it is an honor. Yeah, it is. Yeah, why not?
All
right. You can brush the feathers afterwards.
All right, I'll do it.
Yeah. You sort of.
All right. So this is
this is Russia's. This is an iShares MSCI Russia ETF. So this is an easy access route for everybody to trade. And you know, you don't have to be based in Moscow to trade this one. And look at this. There's a nice 5-way structure here down there, and then it rallies, and there's another 5-way structure. So again, you know, we can extend this by 61.8. Bang! There's where you should be buying it. Thank you very much. And that's proving that this is a zigzag. And so if we go to the larger picture, this is what I think that zigzag looks like. We've just looked at this decline.
Wow.
Okay. And that is exactly a 50% retracement from the pandemic low here. Look.
Yeah.
50%. Now this is a log scale, so you've got to make sure if you want to check my numbers, you got to put first of all this into log scale, and you've got to use your measurements in log scale.
Where does that trade, Peter? You know what?
Where does it trade? This is the iShares MSCI. I think it's hold on.
US?
S.E. Oh yeah, it's definitely traded in the US.
Okay. Cool.
Yeah, it's an iShares. You can check it out. iShares MSCI Russia. And the latest price is 38.44. So you could easily check that on the internet. But this is ready to launch up to about, I think, about 70, 73, 74 over the next year or more. So it's going to be an outlier. You know, if we've got downside risk in US and Europe during that time, this is a great place to be. And I'm recommending this for some of our clients who are long only funds. Because, you know, they say, right, what do I do? Okay, you're telling me there's downside risk in US, Europe. What should I do? I'm telling them to buy things like Hong Kong and Russia.
Okay.
You know, Peter, and selectively in China.
I don't think there's anything we didn't cover. What a great interview. And, you know, I thank you for your giving spirit. I know how much energy you put into your work and research and everything, and you come here and you share it. So you're a very important part of my intelligence gathering method. I always like to know what you're thinking and what you're looking at, and, you know, never take anything blindly. But when my work lines up with it, it really helps me with my biases. So if people are interested in getting your stuff, why don't you tell them how to do that?
Well, thanks. Thanks, Dale. Thanks very much. And well, yeah, if anybody wants to check us out, please have a look at our main website page, which is wavetrack.com. And there's actually quite a bit of information in here. But if you want to actually subscribe to one of our private client services, you just need to go to this registration and go to subscription. And one of our publications is the Elliot Wave Compass report. It's an online report which we post twice a week.
Great.
It covers stock indices, bonds, currencies, and commodities. And we have a pretty established splattering of different contracts there. You can read more about that if you click on the details here. And it's $39 a month, so it shouldn't really break your pocket.
Yeah. Well, Peter, you know what? I want to thank you for, sharing all these ideas and making me smarter in the markets.
And that's coming from a person like yourself. That's high praise indeed. Thanks,
Yes.
Thanks a lot, Dale.
So great interview, Peter. Thank you so much. We've laid out some nice Peter's laid out some very nice road maps. I suggest you watch this video over and take some notes and make 2022 one of your best years out there. And thank you, Peter, very much. Good hunting, my trading warrior brother. And we'll be talking again soon.
All the best, Dale. Thank you very much.
Okay, that's a wrap, everyone. Good hunting the rest of the week. NFP tomorrow. Good hunting on that. And I'll see you next week. Adios. And remember, don't just count your waves, count your blessings. See ya. Thanks, Peter.